And we're going to talk about a little bit of oil right now. Oil really getting hammered today, hitting an 18-year low. We're going to toss things over to Tim Seymour with more. And Tim, what are you seeing when you see these kind of results for WTI and Brent crude? What do you think?
Shocking, Frank. Thanks for jumping in there. And if you look around the country and also look at sub-pricing below what we're seeing in the futures markets, you're actually seeing American oil being priced at $10 a barrel in a handful of North American hubs. We know some of the supply issues. We know the supply issues. People may not be aware of the storage issues, which are out of control. There's no place to put it. Now, ultimately, I believe this is an interesting time for oil. And just to take a big top-down look at it, 18 years ago, which we're now going back to those lows. In fact, that was the early days of the commodity supercycle. Oil went through an overshoot on the way down. Global oil demand was 77 million barrels a day. Even in the pullback and in a global, call it demand shock, it's going to be 100 million barrels a day. And at that point, we were producing somewhere in the neighborhood of again, 40% less oil. But ultimately, what has to happen in the oil sector is you're going to have to see a supply response. And I realize that this takes some time to see some equilibrium work itself out. But there's no question that the oil producers that help to kind of exacerbate this situation have to be looking at the dynamics of their budgets. And we've talked about this before, too. Russia breaks even at $42 oil, Saudi 85 on their budgets. But ultimately, this is a case where this is unsustainable for every player in the world. And that means there will be a supply response, and markets will price that in ahead of time.
All right, thanks a lot, Tim. We're going to toss things over to Guy Adami. Guy, we're seeing lows for 18-year low for Brent, an 18-year low for WTI, and there's a potential that these OPEC nations could pump even more. What does that mean for the global markets?
Means it seems like they're willing to lose the battle to win the war. I mean, if I'm trying to play what's going on geopolitically in terms of what they're attempting to do. So unfortunately, it looks like they're winning right now. In terms of the individual stocks, I think Tim makes an interesting point. For example, names that everybody watching knows. ExxonMobil clearly has issues, and that stock, I think, is going from 31, that trough we recently saw, up to 37 or so. A decent bounce. But then you look at a Chevron, for example, which has gone from that trough of 51 to 71. In terms of percentage, completely outperforming Exxon. So maybe you say to yourself, maybe Chevron's showing themselves to be a bit of a better company, maybe a better stock here. So anecdotally, I think that's how you have to sort of look at this. I'm not suggesting you're plowing into anything, but I think you're able to take things away if you watch carefully the performance of stocks that effectively compete with one another.
Yeah, tough sector, though, to play here, because we know that those majors, they have those really fat dividend yields. We know that a lot of investors have stuck it out in this sector because of that. And we know that the potential for a cut in Exxon would be devastating for sentiment. And there would be a lot of investors who are there who just won't be there anymore. I mean, that being said, when you look at the XLE, that's the Energy Select ETF, Exxon and Chevron make up about a half the weight of that. And then there's another, couple dozen names that make up the rest of the weighting of the XLE. That could be one way to play it. It was at $60 just in January. It's down, I think, at 28 right now if you're looking to play for a quick bounce. But again, the risk is that you continue to see this war play out and crude oil go lower, and you're going to see more pressure on the major E&P guys to maybe cut that dividend.
All right, tossing things back over to Emily. Emily, you've been very bearish on energy. What do you think about the moves that you're seeing? Again, Brent crude down nearly 9%, WTI down more than 6.5%.
Yeah, we've been looking at the dividend yield on energy as more of a distress signal and less of a value play. And for that reason, we've been more focused on getting our exposure to areas like alternative energy through global infrastructure. So stocks that actually have the ability to give you that exposure with some growth potential. The other thing that I would mention is just the kind of the multi-asset implications of all of this. If you have lower for longer oil prices, that's ultimately going to kind of be deflationary or disinflationary. It's going to keep the dollar well bid. It's going to be good for stability and not so good for cyclicality. So there's a lot of implications across portfolios about what that might mean going forward. That's one reason that we've been positioned more towards quality growth, and we've been hesitant to really lean into cyclicality at this point.
Yeah, that's a great point, Emily. And I was going to say it's not just cross-asset implications, but let's get back to the market. Remember, it was that Sunday night when we all heard about the price war. It was really early that day on Sunday between Saudi and Russia. That was the linchpin for the market sell-off that we got into. I'm not saying that that's what this was about, but getting back to credit. High yield is about 10% energy. People forget, and we talk about this triple B tranche that is one essentially notch above high yield, but 10% of that is energy. So there's no question. And despite my comments earlier that we're relatively constructive on market dynamics, there's no question. If this rapidly deteriorates, it will overshoot to the downside, and there will be a credit domino effect that doesn't have to necessarily fall into every other asset class. But energy really matters here, and it's just also should be noted. All the other commodities outside of gold and precious metals that tend to be more of all those other hedges that we know them to be are not trading well. They're not bouncing like the market has. Look at copper, Dr. Copper, you name it. Look at obviously coal and steel prices. If you look at rail volumes this week for the quarter and year over year, we know they're awful. And that tells you that this bigger economic impact of what's going on is something that we're watching.